Hi everyone, welcome to tonight's webinar. I'm your host Jordan Odinsky, an associate with the marketing team, and we have a really exciting program for you tonight. This is actually one of our largest webinars with people tuning in from all across the globe. So wherever you are, thanks for listening. For those of you who are new to OurCrowd is a global leader in equity crowdfunding. We select and vet opportunities, invest our own capital, and invite our global network of investors to invest alongside us. This webinar is the latest installment in our educational webinar series. Feel free to be in touch with any questions or comments about the content and to share this with others who you feel will enjoy. Without further ado, I'd like to introduce OurCrowd's investment partner, David Stark, to present tonight's webinar, Everything You Need to Know About Preemptive Rights. David?
Thanks, Jordan. Hi, everyone. It's great to be here with you. We're going to be discussing preemptive rights and power laws today. But before I jump in, a brief note on our educational webinar series. These are webinars that we like to do as part of our community building efforts in order to be able to provide interesting content to our audience. And we really appreciate getting feedback. So be in touch with any questions or comments. If you have any suggestions for future educational webinar topics, don't hesitate to let us know and we'll find a time to work that into the schedule. So we will be sending out this presentation after today's webinar, and we've included some links here to some of our past webinars. I would suggest that you check out Conquering the Term Sheet, Everything You Need to Know About Deal Terms. That's a 3-part webinar series that we recently did, and I think you will enjoy it. So today's agenda is 2 important topics. I know that when we advertised the webinar, we said it was going to just be about preemptive rights, but I thought it was really important to spend some time talking about power laws as well, because the 2 principles are so interconnected. So we're going to jump right in, and the most important thing to understand about venture investing is that it requires exponential thinking. Now, this is pretty difficult for a lot of us because we're accustomed to thinking linearly in our daily lives. But the core of any successful tech company, and therefore of any successful tech investment, is that the company experiences some period of substantial exponential growth. And during that exponential period, the valuation tends to go up exponentially. And that's where the real returns are generated. Now, the explanation for why companies have this period of exponential growth is rooted in a sociological term coined by Robert Merton called the Matthew effect, which is also known as, the rich get richer and the poor get poorer. And this principle of cumulative advantage, when applied to startups, I think it can be summed up with this sentence, which is that exceptional performance attracts new resources as well as rewards that facilitate continued high performance, and then the cycle repeats itself. So really it's a reinforcing loop, and the company's advantage gets stronger over time, and therefore the value is created at an accelerating rate. And that's why you end up witnessing this period of exponential growth. Now, that concept of exponential growth then directly translates into venture capital returns across the industry. And what you'll notice in this chart on the top right corner is that the actual return distribution does not look linear, but it actually follows a power law, and it has this exponential arc to it. And that's because the bulk of returns are generated by a small percentage of the investments. And this is something that's pretty widely accepted and observed across the industry, both across fund performance and within individual funds, their performance of their portfolio companies. Horsley Bridge, who is a long-time institutional LP in VC funds, they're pretty transparent about their data, and they've shown that of their hundreds of VC investments since 1985, about 6% of those investments have generated 60% of the total returns. So you really can see the power law at play. But the thing that's important to recognize, obviously, is that from the outset, when the investors make those investments, they have no way of knowing which of those companies are going to be the ones that emerge as the winners and generate all of the returns. And Trent Griffin has a great quote, which is that the task of a venture capitalist is to experiment on a trial and error basis in order to discover success from within a portfolio, right? So those successful companies that end up having that exponential arc of growth end up only emerging over time as the winners. And this is really important, and this is kind of a quick aside because it's not the main topic for today's webinar series. The main topic of today's webinar series is actually what you do following the first investment and the importance of your preemptive rights. But just a quick note on also when you're making those initial investments, and that is that you should swing for the fences. And the reason you should be swinging for the fences is knowing that only a small percentage of your investments will be successful. It's important that all of them, each individually, have the potential of being home runs, and in fact, of being grand slams. And if you actually look at the chart of fund performance mapped against failure rate of the number of investments that the funds make that actually are not successful, you see this really interesting U curve. And what the U curve shows on the left side of the curve is not surprising at all. And that is that underperforming funds have a higher percentage of companies that fail. What is more surprising is that the best performing funds also have a higher percentage of companies fail, of investments that fail, than just mediocre funds. And I think that speaks to the fact that the best funds have deeply internalized this notion of power laws, and that they know that they're going to swing for really, really large wins. And yes, if they miss, it will go to zero. And they're not afraid of that, because what they want to make sure is that when they connect, it actually generates an outsized return. And in fact, in business and investing, the risk-reward proposition of swinging for the fences is even greater than in baseball, because in baseball, the potential return is truncated, because at most you can score 4 runs if you hit a grand slam. In business and investing, there's unlimited upside when you actually are able to pick a successful winner. So bringing this back to the importance of preemptive rights. So as we mentioned, the winners will emerge from within the portfolio. And what's most important is that you then continue to press your bets on those winners. And Fred Wilson has a really great analogy to poker. And he said that early stage investing is a lot like poker. And I apologize for those of you who are less familiar with the game, but bear with me and hopefully I'll do a good enough job of making clear how it works. So if you really think about the ante, the whole point of the ante is everyone around the table puts in their initial bet just to be able to see their cards. And the equivalent in venture is you make that initial investment just to be able to buy yourself the next 12 to 18 months of getting to know the company, getting to learn more about the management team's skills and weaknesses, getting to learn more about the market, getting to see if they're able to execute on the product. And then what happens is you get dealt another round of cards. And the whole idea at that point, once you get your next round of cards, is that if your hand is getting stronger and your conviction in that hand being a winning hand is increasing, then you should increase the betting, putting more money at risk in each subsequent round. But if you realize that your hand is not good, and in fact, the risk-reward profile is even less strong now than it was before, then you should fold your cards and you should preserve your capital for the next hand. The same thing is true in venture capital. It's that as your hand is getting stronger, you want to continue to be pressing your bets, because the winners, as we just noted, are so few and far between that when they start to emerge and you start to identify which ones are on that breakout trajectory, you want to have as much money invested on those as possible. I guess the way that I would think about it, again, when it comes to poker, is that if you were sitting with a royal flush, if you could, you'd mortgage your house and go all in, because there's no way that that hand could lose. And that's how smart poker players win. It's also how smart VCs win. And this is why the preemptive right is the most important right in venture capital. Preemptive rights, by the way, are sometimes referred to as pro rata rights, so I'll use those terms somewhat interchangeably. So quick, just a definition for those of you who are less familiar with how preemptive rights work. The preemptive right is the right of a shareholder to maintain his or her current share of the ownership of a company by being able to purchase a proportionate share of any new stock issues. So put in simpler English, if you own a certain amount of a company and the company is going to now raise more capital and sell another percentage of that company, you have the ability to participate in that next financing round with the amount of money that would keep your ownership share constant. The implication of this is that preemptive rights protect an investor's ability to continue betting on the winning hands within the portfolio. And again, the reason why that's so important, and going back to the poker analogy, is imagine if you had that hand that you knew that couldn't be beat, and all of a sudden someone came out of nowhere to the table and said, "Sorry, ma'am, you're not allowed to invest anymore in this round." That would be extremely frustrating because you know that you can't lose. The same thing happens sometimes in venture capital. Unless you're guaranteed the ability to continue to participate, if a company's doing exceptionally well, they're going to attract a lot of interest from new outside investors. And those new outside investors are going to want to own as much of the company as they can. And they will potentially want to crowd out other investors from being able to participate. It will be a food fight for allocation. And unless you have a guaranteed seat at the table, there's nothing protecting your ability to be able to continue to invest in that company. And that's why the preemptive right is so important. An important thing to realize whenever you're doing investments is whether that right is a part of your investment. And if you're doing angel investments directly as an individual angel, make sure that that preemptive right is given to all shareholders and not just major investors, because in many financing rounds, you'll see this definition of major investors, which means only investors that own a threshold above a certain amount are actually legally protected as far as preemptive rights. But that's something to definitely pay attention to. I put a link at the bottom of the slide to Mark Suster has a great blog post, which is an authoritative guide to pro rata rights, which explains a lot more about these dynamics that you can understand. And throughout the presentation, you'll see links to suggested supplemental reading that you should check out. So a quick quantitative example relating to preemptive rights. So let's say that you have a company called AirCnc, and you own 10% of AirCnc. Now, the company's doing really well. They're meeting all their milestones, and they get approached by another investor to lead a subsequent $10 million financing round. Now, thanks to your preemptive right, you have the right to continue to own your 10% stake also post this financing round. So if you take 10% of $10 million, then that equals $1 million. So it means that you, as an investor with preemptive rights, have the ability to participate in this round with an additional investment of $1 million. So the main point that I'm trying to get across is that preemptive rights are not just a right, but they're a valuable asset. They are what allows you to really be taking advantage of the numbers game that is venture capital, which is that when you identify from within the portfolio which of the companies are most successful, that you can continue increasing your stake or at least maintaining your stake in those so that you can benefit from that exponential period of value creation that that company will have. See, a lot of people, I think, misunderstand preemptive rights, and they think of them as being downside protection. And it's that if the company's not doing well and they have to raise money at a lower valuation, that you have a preemptive right, which kind of ensures your ability to be able to participate and protects you from getting your equity wiped out. But I think that that's the wrong way entirely to think about them. I think that preemptive rights are all about being able to preserve the upside, and that's the way that you should approach them as well. And that's why they're really a valuable asset. Now, this asset has actually become even more valuable now more than ever because of some macro trends that we're seeing in the market. And the first of these trends is that companies are raising more money now prior to exit than they had in the past. If you look at the last 5 years versus the previous 5 years, as far as the median amount raised prior to IPO, then the last 5 years, companies have raised 60% more than the previous 5 years. So companies are staying private longer and they're raising more money. And that means that you, as an individual investor or as an institutional investor, it's more important to be able to participate in those rounds all the way to exit so that you're not getting diluted more and more over time. And the other point that's a really important thing that we're witnessing in the markets is that all of the value capture is occurring while companies are still private. So if you look here and you compare the last generation of major tech companies of Apple and Microsoft and Oracle and even Amazon, even after those companies went public, they generated substantial returns for their public market investors. The same is not true for companies like Twitter and Facebook and LinkedIn. And that has changed. And if you actually bought Facebook stock at its IPO, if you wanted to realize a similar multiple that Microsoft's public shareholders earned, then Facebook's market cap would need to reach nearly $50 trillion, which is roughly the size of the total market cap of all publicly traded companies in the world, right? So what it's showing you is that not only are companies taking longer to go public and raising more, but that the majority of the value creation is happening while they're private. And because these companies, right, these winners have the opportunity to be a lot bigger than ever before because of internet penetration and because the ability to scale globally is so much greater, then again, it takes them more capital and you want to have the ability to continue to participate. And what we're actually seeing, what's interesting, is that public market investors like hedge funds and pension funds have actually moved into later stage private investing because they've recognized this trend as well. an interesting chart that appeared in the Wall Street Journal last year shows the performance of Y Combinator's portfolio. So Y Combinator is probably the most well-known accelerator based on the West Coast, and they've invested in nearly 900 companies from 2005 to 2015. And of those 900, so about 6 are now worth $1 billion or more, which again I think shows you the relative proportion of how many companies have that potential of becoming that large. But more interesting, I think, to the point I was making before about companies taking longer to exit, is that none of their companies, of the 900 companies that they invested in from 2005 to 2015, has yet to hold an IPO. So what we're seeing is that these companies realize that they have the potential of scaling so much greater before needing to go public. So the private investors are really benefiting. Now, what this has led to is a trend that I want to talk about today, which is the opportunity fund trend. And the reason why opportunity funds have emerged is that every venture firm, and I'll actually read this quote, it's somewhat long, but I think it's worth reading in its entirety. Every venture firm wants to invest in the handful of companies that generate the highest return, and they compete vigorously for the chance to invest in these companies. Some compete on the basis of their brand, some offer to pay the highest price, others suggest that they bring strategic value or that they have unique insight using a data-driven approach. Right? So this is what you always see. You see these types of firms that are competing to get into these breakout stars. Yet those who pioneered opportunity funds, which I'll explain what they are in a second, they recognize that while everyone competes to invest in the best companies, there's a better way to get access to these very best companies, and that is to already be an existing investor. Because if you're already an existing investor in these companies, then you have your preemptive right, and your preemptive right guarantees you the ability to continue investing in these companies. Now, what this has led to a number of firms who have really great early stage portfolios to raise special opportunity funds. These are also known sometimes as overage funds, sometimes as pro rata funds. And these funds are vehicles that are directly designed to be able to take advantage of the pro rata opportunities that come down the line in their most successful portfolio companies. So the fund that actually first pioneered this concept was Union Square Ventures. And Union Square Ventures talks about what led them to the Opportunity Fund. And what led them to the Opportunity Fund is that they always recognized the importance of their pro rata rights and how valuable of an asset that was. But they didn't really know what to do about it. And they actually had a couple of really big successful companies like Zynga and Twitter where they let their pro rata rights go unused because they just didn't have the capital within their fund available to be able to take those allocations. That's because either they had already deployed the full amount of the fund, or also because within a fund's structure, they usually don't want to allocate more than a certain percentage of a fund to specific companies. So they had kind of maxed out in their ability to follow on in Zynga and Twitter, but they knew how valuable those opportunities were and they couldn't take advantage of it. So that's why they launched the Opportunity Fund, to be able to continue to invest in their most established and successful companies. We got data from PitchBook on how their various funds have performed. If you look at their fund performance, so their inaugural fund in 2004 was their best performing fund ever, and Fred Wilson has written a lot about how it was the best performing fund that he's ever been a part of, generated a 67% return. But what's really interesting is that the Opportunity Fund from 2010 is not far behind, and many of its portfolio companies have not yet matured or reached exit. So there's reason to believe that that fund will even outperform their best performing fund to date, which was their inaugural fund. Another case study is the Foundry Group. So Foundry Group launched a $225 million fund that they're calling Foundry Group Select. And again, same principle, to invest solely in Foundry Group portfolio companies that have achieved significant success. So the idea being that you now have this unique vantage point of identifying these companies. You have a guaranteed seat at the table, so you should be providing your investors with an ability to take advantage of those opportunities. And if you look at their fund's performance, again, this data comes from PitchBook, Foundry Group Select has been the best performing fund that Foundry Group has had. A couple of other case studies that are newer in vintage and therefore we don't yet have any data on is Y Combinator. So the accelerator that we mentioned earlier that's invested in these 900 companies. So until recently, they actually didn't have an ability to continue following on in their investments, which you can imagine was frustrating as those 6 companies were reaching their multi-billion-dollar valuations. So Y Combinator recently announced that they are raising that they raised a $700 million continuity fund to be able to do their pro rata in all YC Combinator companies moving forward. Another case study is Greycroft recently launched a $200 million growth fund, again, with the same idea of having dry powder to be able to support their best companies. So that brings us to the OurCrowd Continuity Fund and what we at OurCrowd are doing when we recognize this trend and how valuable these pro rata rights have become. So a brief note on OurCrowd is that OurCrowd is one of the largest equity crowdfunding platforms in the world. We've raised $200 million to date to invest in portfolio companies. We have had, this is actually outdated, we've had 5 exits to date. We've been around for a little over 3 years. We have over 11,000 accredited investors around the world, global offices, and the number that I want to just draw your attention to most closely is the number of portfolio companies. So this number also, it's now not 91, but it's 94 portfolio companies. And when we took a step back, we realized that that is an extremely valuable asset, which is that we have preemptive rights across this portfolio of 94 companies. And inevitably, assuming that we're doing our jobs well, within that portfolio of 94 companies, we will have companies that emerge as these exponential winners, right, as these breakout stars. And often what happens is that in those situations, the other VC funds around the table will say, okay, whatever preemptive rights you don't want to exercise, we'll gladly take. What we realize is rather than let those unexercised preemptive rights go to the benefit of other investors, we should create a vehicle that gives our investors access to these opportunities so that they could be benefiting and getting into these types of companies. So because of that, we launched a fund called the OurCrowd Continuity Fund, also known as OC Squared. And it's a dedicated fund that leverages our preemptive rights to provide our investors access to these companies. And the way that it works is that it has a very strict set of investment criteria, and it's an automated fund that only invests in follow-on rounds for OurCrowd portfolio companies, and only when they are up rounds with other leading institutional investors that are leading the round. Okay, so the idea being that we think that if a company is now raising at a minimum of a 20% higher valuation than the last round that we invested in, and there's an institutional investor that is leading that round, that is a strong signal that this is a company with good positive momentum, and that is a type of company where you want to be following on, and you want to be exercising your pro rata rights because it could be well on its way to being one of these exponential winners. So the idea of the fund is that it will give first access to any investors in the fund to capture these unexercised preemptives. And the main kind of concept is that just like our core business is all about democratizing early stage investing, we want to be able to democratize the opportunity fund strategy and be able to bring this opportunity to any investor around the world with much smaller investment size minimums than would be required to get access to a larger venture capital firm. Just as a quick note, the way that we came up with the investment criteria for OurCrowd Continuity Fund, in addition to a number of other things that we thought through, Peter Thiel actually, as an interesting point of validation, he said that if you backtest founders fund portfolios, one heuristic that's worked shockingly well is that you should always exercise your pro rata participation rights whenever a smart VC was leading a portfolio company's up round, right? So the way that we've designed ours is kind of in the same spirit. So it's only for up rounds led by other institutional investors. You might ask yourself, I mean, there are lots of questions that we'd be happy to answer, but the main point is that for a variety of reasons, investors don't always exercise these preemptives, but these preemptives in these types of companies often represent a really interesting investment opportunity. So just some supplemental reading that in case you want to learn more, you can go to Brad Feld's blog or Union Squared Ventures page, and they can explain why it is that they launched their own opportunity funds. We wrote a blog post on the importance of swinging for the fences. Fred Wilson has a blog post on pro rata and why that's such an important right. And I encourage you to read any of those things. As always, you can be in touch with us with any questions, and we'd love to hear your feedback on the webinar. If you'd like any more information about the OurCrowd Continuity Fund, feel free to be in touch with me directly at david@ourcrowd.com, or you can email any contact person at OurCrowd. Thank you so much for tuning in, and we look forward to seeing you on our next educational webinar.